Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back, Sonu. This is a live one. We haven't done this in a couple weeks. We were down in Florida at Excel recently, but this is episode 102 of Carson's Facts versus Feelings. We're going to talk about the F word a lot today. The Fed. Title. The title of this one is The Fed Goes Big. All right, first things first, Sonu, how you feeling today?
I'm good. I'm a little tired. I think my daughter's not been sleeping well, so she's just crawling into our bed every night. And you probably you have 3 kids. You probably know that a 80-year-old crawling into bed at night is not the best for your sleep. Nor they sleep fine. Like I'm the one who doesn't sleep well.
Yeah, sometimes we have our 135-pound Great Pyrenees in the bed. Then we have my youngest son, Gus, who just turned 12, sometimes show up in the bed. And then I just leave because there's not enough room. It's just miserable.
That's what I should do.
But speaking of miserable, my Bengals are 0-3. We took my son, Gus, for his 12th birthday last night.
You went last night?
Yeah, I went to Monday Night Football. I'm dragging today, too. Went to Monday Night Football last night. Congrats to the Redskins. They looked really good. Their quarterback, my goodness gracious. Oh, Chicago, you missed out. You passed on the wrong quarterback, Chicago. We'll leave it there. Sorry. So I know you're not really a huge Bear fan, but they took the wrong quarterback. But anyway, Bengals 0-3. So out late, just kind of frustrated. Now, I'm glad we get to do this. This is definitely the highlight of my day, Sonu. So we're just going to get all into it here. We're going to definitely talk about the Fed and the rate cuts and kind of what it all means. Had some recent economic data that, for the most part, looked like there's no recession coming. Talk about the economy. And then, Sonu, you did some great work on the consumer. Are they truly in a sea of debt? Maybe not. We'll talk about the consumer and economy in good shape. And then finish things up with, is this a sugar high? You've got some really interesting data that suggests no, this is not a sugar high, but we'll dig into it. But Sonu, you and I did this yesterday with our Carson partners on our morning call. Thought you gave a really nice description, for 3 or 4 minutes on what the Fed did exactly. We know they cut 50 basis points, first cut since March, I believe, Ides of March, back in 2020, March 15th, and I believe the S&P dropped like 10% that day. Okay, so approximately close enough for government work. We did not drop 10% this time. Talk to me about what the Fed just did last week here.
It was significant. A 50 basis point cut, 0.5 percentage points.
Yep. Took
the federal funds rate down from 4.75, from 5.25, 5.5 range.
So you just lost me. I don't know what in the world. See, we're struggling. That's why I always just call it the upper range. We'll say 5.25 upper range. It is when is the Fed stop going to use these ranges? Why do we didn't use that ranges 20 years ago?
You don't want me to get into that.
Yeah.
They have it's a floor and ceiling approach.
Yeah.
Like, you do not want me to get into why they use
we won't then. All right.
But okay, we'll do it this way. They've dropped it from 5.5 to 5%. How about that? That's the upper end of their range.
Perfect.
Right? And 2 years back, last year is when they took it all the way to 5%. Remember, we are at 0.25 back in March of 2020, as you mentioned. That's the last time they cut, right? And 50 basis points was kind of expected after we got that. I guess we haven't talked about it on the podcast because
last week was with Frank. So we didn't
so we have to back up all the way. Yeah. So Thursday before the Fed meeting, this is September 12th. Right?
Mm-hmm.
September 12th, we get this piece. Till September 12th a.m., till the morning, everyone is like, okay, they're going to cut only 25 basis points. 85% probability based on, Fed funds futures markets, right? Then Fed whisperer Nick Timiraos at the Wall Street Journal, you have to follow him. Like, if you're in this business, you cannot not follow him, right? And he's like, oh, the Fed's thinking about, maybe a 50 basis point cut. And boom, suddenly the pricing shifts. Markets are pricing in maybe 65% probability of 50 basis point cut, which means they were not fully baking it in, but it's not completely unexpected, right? And guess what happened? They cut 50 basis points, right? And I think the big change was in their statement. They said previously their statements basically said We are committed to returning inflation to a 2% objective. That's their goal. That's their mandate. Now they added in, we are also committed to supporting maximum employment. And in their eyes, the risk of unemployment going higher versus the risk of inflation going higher, they're the same right now. They were not saying this like even up to 2 months ago. And that's essentially the justification for cutting 50 basis points. Essentially, they're saying, look, we've got the labor markets back. And September is key because every 3 months, right? June, September, December, and March, they released the dot plot. And in their dot plot, they said we're going to basically cut 100 basis points in 2024, including the 50 basis points that they just did. But I think the key takeaway was their unemployment projections. Right now, the unemployment rate is 4.2%. They expect it to rise to 4.4 this year. And in 2025, they expect it to stay at 4.4. Now, that's a function of their policy, right? All these projections are based on, is a reflection of appropriate policy, as they call it. Essentially, they're telling us, we don't want the unemployment to rise much higher from here. We're going to cap it, which means what? They've put a floor on the economy. And I think that's good for markets. That's good for the economy as well.
No, excellent stuff there. You mentioned September 12th when the Nick Timros article came out a couple Thursdays ago. And again, we were down at Excel, our conference with our Carson partners. We had a lot of fun. If you're interested in coming next year, look into it, carsongroup.com. We can maybe make that happen. But I'll put it this way. On September 11th, right, we were, again, in Florida talking. That morning was a bloodbath, down 1.6% on the S&P the first 90 minutes. Sonu, you and I are different meetings, running around, doing our things. Oh, wow, stocks are flat. Like, okay, good. Then we go to another meeting, and then by the close, stocks are up over 1%. So who knows why that happened? Maybe the rumors of the Timros article, or maybe just stocks stopped going down. The bottom line, September 11th, obviously, easy day to remember in our country's history, and we obviously focused a little bit on September 11th in last week's podcast with Frank Capillari, so definitely listen to that podcast, as Frank's been very, very right, and he's still bullish, which is a good thing. But on September 11th, saw a big reversal. The last time we saw a reversal like that, Sonu, down that much and then up that much by end of the day, was the end of the bear market 2 years ago in October. Okay, so like it could be a signal. Okay, we just hit a fairly significant low, and it felt pretty ugly because the first couple weeks of September weren't all that, or first 10 days or so, were not very good, and it kind of reminded me a lot of August. But we're going to talk more about markets, I guess. I get a little ahead of myself in a minute. But overall, again, I guess, let's talk about the idea of normalization cuts, recessionary cuts, and panic cuts. Panic cut, like it sounds, is during a 100-year pandemic, you start cutting, okay? Recessionary cut is like it sounds in 2001 and 2007 when the economy is really starting to hit some problems, they started to cut. But now we have been in the camp, honestly, all year saying when they cut, this will be a normalization cut. I've got some data on it, but talk to me about why this is more of a normalization cut versus a recessionary cut. I don't think we're in a panic, so it's one or the other. What do you think?
I think this is one of those charts that I really like, the ones you put out. I mean, we put that on our blog too, carsongroup.com/research. Yes. I think we put it in 2 or 3 of our blogs over the last week.
Just keep throwing it in every blog.
Yes. It's very relevant, right? Like you said, a panic cut is, after there's some like a 100-year pandemic, or like after the 87 crash.
Yes.
Right? I'm going from memory here. So, hopefully you'll be impressed that I remember that chart as well as I
You always impress me, Sonu.
And thank you. It's a vote of confidence there. But,
yes.
No, then the 1998 Asian financial crisis, that was a panic cut, right? But then you think about, and this is where people are like, oh, if the Fed cuts 50 basis points, that's bad for markets, because they're comparing it to 2007 when they did 50 basis points. What did we see? A recession after that. 2001, they cut in January of that year. We got a recession in March. 1990, they cut in July. We got a recession in July. And so it's almost like, I think people are getting that causality reversed. They're like, oh, the Fed cut 50 basis points, so we're going to recession. No, it doesn't work that way. They cut 50 basis points because they were behind the curve, right? And they were already well behind the curve. Data was already going down, especially in 2001 and 2007, right? Like housing was already falling, all of that. I think it's safe to say the Fed waited too long. This is about, I'll use Powell's own word, recalibration. Or we like to think of it as normalization, as you said, right? Now, he did say the labor market has been cooling. We've talked about that last 3 months. Payrolls have averaged about 116,000. That's a big fall off from, let's say, 200,000, 250,000 earlier this year, right? And the unemployment rate has gone up to 4.2. A year ago, it was 3.5%. But if we stop here, this is not a bad place to be. And Powell got to that. He said, look, the current level, if these things stop going down, it's not a bad place to be. Layoffs are low. Unemployment claims for initial benefits, that is, for unemployment claims, that's also low. It dropped to the lowest level in months last week, right? But that's why I think the most significant thing Powell said was the time to support the labor market is when it's strong and not when you begin to see layoffs. What does that mean? This big cut was about risk management. It was about getting ahead of the data, unlike what happened in 1990, 2001, and 2007.
Now, well said. Remember the day of the cut a couple Wednesdays ago, we had a big spike early, then some drift lower, some weakness. Our friends at Bespoke, quote them all the time, obviously do great work. They've looked at various Fed meetings over the past 20 years. You know what tends to happen? You get a pop around a decision. This could be a hike, it could be a cut, or no decision, whatever it is. They looked at them all, smushed them all together. You get a pop, and then you get some weakness the rest of the day. So that played out, but we came in on Thursday morning where the S&P had a very big day. I believe up over 1.5% or so. It was, I forget the exact number, but a very, very solid day.
Yeah, about 1.7, right? And then tech rallied. I mean, all three indices hit record highs last Thursday, the day after the Fed meeting. I mean, this is why, like, yes, we look at a lot of the economic data, but you also have to look at markets. I think markets are as good a signal as anything else. It's just a key piece of the puzzle, right? It's not the only thing you should look at. Mid caps and small caps, which are the most really cyclical areas of equities, those rallied. The Russell 2000 was up 6% from when that Nick Timurrow's article came out last Friday, right? I think it went up, and the mid caps too. Cyclical sectors have outperformed: energy, communication services, consumer discretionary, industrials, and financial. So I think that's a sign that, essentially the Fed's backstop the labor market, which means they're backstopping the economy. And that's a growth story that's good for profits.
No, exactly. I'll be honest. I don't watch too many of the Powell press conferences. I'll see the highlights. I'll read your notes. It's like, but I did watch that one, right? And I was impressed by how relaxed he was. He had a couple jokes. He had a couple zingers. I don't know if he's always that way, but I think he's pretty comfortable in how he was presenting what the Fed is up to. And I got a kick out of that. Also, Steve Leisman, I'm a fan of Steve. I mean, I've been on Steve and talked to him many times. He called a woman "sir." That was an interesting.
No, you know what? Before the Fed meeting, I was actually, for the first time, I was a little tense. I mean, obviously, we manage money. I sleep well at night. We do it together.
You were excited. I know.
I was a little tense before the Fed meeting. I was like, if they don't go big, they're choosing to fall behind the data. And I was like, we've got good gains since the Timurrow's piece came out. Market's kind of expecting 50 basis points. If they went 25, essentially they're like closing their eyes and saying, no, we're still worried about inflation when we shouldn't be. I was thinking, okay, we could see a big sell-off in markets. I mean, again, you never know what the counterfactual is. The good news is, like you said, even after the meeting, there was some choppiness, but we didn't give away those gains. And the next day, everything raised to record highs, right? So I think that was good. But I was a little tense before the meeting, thinking like, this is a big one.
Well, it was, and then you layer in September, and we'll get into some of that stuff in a minute. Just some more context around things. We took a look at the last 10 rate cuts going back to the early 80s, Sonu. Just looking at all of them, all right? 1 year later, S&P 500 up 8 out of 10 times, up about 8% on average. It's not all that abnormal, right? Your average year is about 8 or 9%, usually higher about 7 out of 10 times, so a little bit better. Yes, 2001, 2007 were big drops, and those were the 2 times we were down, but most of the time you're higher. And then when you look at those normalization cuts, like you said, we've got 84, 89, 95, and 2019 we classified as normalization cuts, higher a year later, 4 out of 4 times every time. S&P up 13.2% on average. So again, if we're in a strong economy, we're going to focus on the economy here in a minute or two, which we still don't see a recession. We're calling this a normalization cut. That's positive. Now, Bespoke, Paul and the gang, they allowed, they let me share their data. So thank you. It's behind their paywall. I wrote a blog. So today it'll be out by the time you listen to this, carsongroup.com/research. They let me share their chart with their data behind their paywall. And Bespoke found, Sonu, this is real. I thought it was really interesting. I didn't think of looking at it like this. They beat me to it, which is good. When you're up 25% for the year, the previous 12 months on the S&P 500 or more. Okay, so let's call it a big rally, and then the Fed cuts. So you rally a whole bunch, and then the Fed cuts. According to Bespoke's data, They go back to like the 80s on this. 1 year later, there's been 10 times. Last 10 times, you had a 25% rally or more into a rate cut. 1 year later, that's after a huge rally. Stocks were higher 10 times, every single time, up 19.2% on average. I mean, that's kind of wild. And the other stat that I've done a lot of tweets over the years, when you cut within, and this is probably the most popular, most viral tweet I've ever done. I just kind of toss it out too. I've shared it before. No one cared before, but they cared today for some reason, or last week for some reason. When you're within 2% of an all-time high and the Fed cut. Okay. So what I did the day before, right? If you're, because you got to find somewhere. So the day before, if you're within 2% of all-time high and the Fed cuts the next day, I found 20 instances using Bloomberg data, going back to the early 80s. 1 year later, higher 20 times, about 13.9% average. Median's a little bit less. But when you stack what I just said with what Bespoke just said, you know, we're still overweight equities and have been since December.
Remember, we have only 3 months left of this year, which means, ladies and gentlemen, Ryan just gave away our Outlook 2025.
Yes. Now, I will say this, because what fired a lot of people up on that tweet, in 2007, we were about 3% away from an all-time high, and the Fed did cut. Okay, the Fed cut about 3%, and we all know that spiraled out of control. So, you know, they're going to have a caveat. I had to make a cutoff somewhere. I mean, you have a lot more data points when you do it, but so it is what it is. Yes, there was a cut close-ish to a high in September of 2007 or whatever time it was in 2007, but nonetheless, you know, the one within 2%. So just interesting stuff. Sonu, anything you want to add on the Bespoke stat or the all-time high stat or anything else about the Fed? We probably need to move forward.
Yeah, no, just connecting that to, you know, the other part of the market, which is the bond market.
Yeah.
Like one question I got was, I'm sure you got it too. Like, wait a minute, yeah. The Fed is cutting and they're dovish, right? They expect to cut 100 basis points this year and another 100 basis points next year. So taking the Fed funds rate from, say, 5.5 to 3.5. Right, by the end of this year, in sort of 15 months. Why are Treasury yields rising then? Right now, so that's a kind of a puzzle. Wait, they're cutting rates, but longer term Treasury yields are rising. What's happening? Right now, some of this is already priced in, but essentially, there's a growth story. This is like I said, the Fed's backstopping economic growth by putting a cap on unemployment. Essentially, if you think about options and a put option, you always talk about the Fed put. Right, the Fed put is on the economy. I don't think it's on markets. The markets benefit as a result of that. They raised the strike price on their put. I mean, Neil Dutta talked about this, our friend at Renmac. Mm-hmm. And look, and if they've cut off that left tail risk of economic growth in a recession, then yields have to actually go up. It shouldn't be going down. At best, it should, it should stay flat or slightly higher, right? Whereas if the recession risk had risen, and this is why I was a little tense about going into the meeting, if they had cut only 25 basis points, I think that left tail risk, recession risk would have been higher. Long-term yields would have gone down. So be careful what you wish for, right? That's all I'm saying.
No, well said. We'll probably wrap it up, the Fed discussion there. But obviously, the bottom line to us is there's no recession. The Fed probably should have cut 7 weeks ago. We were on this very podcast and said that. They got out a big eraser, went with 50, following the data, and now we've got more cuts coming, which we'll talk about in the future. Sonu, story time. We're up at the halfway point. I was driving my son, Sebastian, home from, what was it? Football. I don't know. All I am is an Uber. It was football practice. And just running home because he probably had something else after that.
And you were driving. It wasn't an Uber, right?
I was driving. I think it was Thursday. Yeah, it was definitely Thursday. Thursday at 5:10-ish, right? A mile from my house, because where do most accidents happen? A mile from your house. Of course, you drive mostly a mile from your house.
I didn't know that, actually.
I think it's true. I don't know. It makes sense because you're always driving a mile from your house, right? I mean, most of the time. I don't know. But bottom line is I'm driving, and there are some deer. See where this is going, that live around us, and I'm just driving probably 40 miles an hour, and all of a sudden, boom, this deer just jumped out. I mean, there was nothing I could do. Jumped out, smashes into the front of, the front driver's side of my car, and I mean, like, I see him kind of fly, and I hit him pretty hard. Sorry, deer. Yeah. And luckily my car still worked. And my son and Sebastian and I were like, I wasn't like shaken up because I knew kind of what happened. At first, you're like, oh my God, what did I hit? And like, oh, it was a deer.
Were you going at 30 miles an hour or something?
Yeah,
like
30, 35, just kind of a standard road there, and hard enough to leave a mark. So we turn around to go just look for the poor guy. And then as I'm turning around, like, Sebastian, like, look at that, Dad. Like the air conditioning vents were like shooting out smoke. Okay.
Oh, really?
And it
Wow.
didn't smell very good. So I was like, oh boy, the car worked. No. I knew it was pretty banged up. All of a sudden I started getting all these alerts on my dash going off. We go back and look, we couldn't find the deer. We could not find the deer. Then I said, we got to get home. My car's kind of making noises and I knew it wasn't good. Then I get out and look at it.
Drove in it when it was smoking.
Well, no one ever said I was smart. I just wanted to get home. I know. I mean, it wasn't like the car was on fire. It just was something coming out of the air conditioning vent. And it smelled a little odd, but I said, I'm just going to get this thing home. I was close. I didn't want to stay on the side of the road. It's a busy road. So anyway, so we go home and I look at the front. And the whole front's all smashed in pretty good. Wow. Call police. Here's what you do. I didn't know how to do it. You file a police report. Police come and they look at everything. And they do it all. And I just got a call. So they gave me a rental car. So whatever. Actually, I have a Dodge Durango that's white. They gave me a Dodge Durango that's black. For a rental car, so that works. Yeah, it's whatever. It's same car. It's good. I just got a call from the body shop. They said it's like $12,000 to fix it, but they were going to. Wow. They were approved up to like 18 grand or something to fix it. So they're not totaling it. And they said it still could take like up to 2 weeks. You're talking about supply chains. It's coming back real time. He goes, yeah, we're still having trouble getting a lot of parts. It could be another 2 weeks. I'm like, oh, whatever. I don't need the car. I got a new one. So anyway, so that's that. But everything worked out. Not for the deer. I would say probably everything to work out for the poor deer. I hope he went off and just passed away because he got pretty messed up.
So they didn't find it, huh?
No, then the police went back and looked and they didn't see him. I mean, he probably got a jolt of adrenaline or something. Just got out of there and so sorry to the poor guy. But anyway, so I don't know if I'm helping the economy or I'm insurance stocks. Not a recommendation. Insurance stocks have been strong, so maybe I don't know if that's premium.
Insurance premiums have been going up because people have been apparently getting into more accidents since COVID. But I think that's not deer. It has to do with people are driving faster on the road. Well,
exactly. Yeah. But now I've not helped people live around me. So I know Phil listens to our podcast, so he'll like his shout out. But sorry, Phil, if your rates go up because people live in our neighborhood now might have more issues with deer. Oh, there are a lot of deer. So anyway, so let's talk about the economy here. Let's talk about that economy. Sonu, last week we had a lot of data. I mean, you and I could talk all day. I know retail sales and initial claims, and I mean, there's more. You can get into it. But it sure felt like to me, every day we had data. The results came in better than expected. You want to kind of build on that?
There's a bit of a change from July and August, right?
Yeah.
I mean, we got industrial production data. I mean, that was fairly positive, especially those things I've talked about this before, like the AI story. If you're looking at it from the macroeconomic data or within the macroeconomic data, you're seeing industrial production of high-tech equipment, right? Computers, communication equipment, semiconductor chips, things like that. That's booming. That's running about 34% higher than it was before the pandemic, right? That's huge. And this is not because of prices, right? This is in volume terms. It's sort of inflation adjusted. Electrical equipment, and shout out to Skanda Amarnath who pointed us towards this data set. I mean, electrical equipment production is running, about same thing, about 30% higher than it was before the pandemic. It's been over the last 3 months, I think it's like some ridiculously high level, like 25% annualized pace or something like that. I don't have the numbers in front of me. So that's huge, right? That's the supply side of the economy. That's the industrial side. So that's positive, despite everyone talking about, manufacturing is in a recession. I think manufacturing could be doing better, right? I don't think it's going gangbusters. There are pockets which are doing well, like I just talked about, but I don't think it's in a recession, right? Then you come to the side that actually matters, consumption. I'm not saying manufacturing doesn't matter. It does. But 70% of GDP is consumption. Retail sales came a surprise to the upside, 0.1% month over month in August. People are expecting a negative number. That's despite weakness in auto sales and gas station sales. Remember, prices are falling. New vehicle prices, used vehicle prices are falling, right? We have deflation there. Gas prices are falling. So you would expect nominal sales to be weak anyway. But so it was a pleasant surprise that it was positive, right? But then you take all the volatile stuff out, autos, gas station sales, tobacco, things like that. Core sales, control group, as they call it, that goes into GDP.
Yeah.
Last 3 months, Ryan, it's been up close to 6.5% annualized pace. And remember, this is also not because of prices. It is nominal data, but it's not because of prices. We know outside of food and energy, commodity prices have been coming down. Online sales, right? Up 13.5% annualized. June, July, August. That's massive. I mean, consumer balance sheets are in good shape. We are seeing that. Yes, the risks are rising, and that's why I think what the Fed did is so important. But right now, we're in a good place.
No, that's really interesting. I did a tweet that kind of summarized a lot of last week here. I'm just going to kind of read it. Let's review. September has not been the end of the world. Retail sales beat, the control group beat, and last month revised higher. Industrial production beat, starts and permits beat, NAHB, that's a housing index, beat. Empire State Manufacturing beat. Oh, and by the way, initial claims were the lowest in 4 months at 219. And the Atlanta Fed GDP now for the third quarter is a very solid, you could argue above trend, 2.9%. Who knows if that's where GDP will come in? But I mean, those are the highlights of last week. Not too bad, right?
Yeah. No, I finally housing, I think, is going to be a really key story going forward, because that's going to tell us, are these rate cuts working? Which part of everyone's like, oh, we may be late cycle, but then if housing comes back, housing activity rises from here. It's been depressed, especially over the last few months, because mortgage rates are above 7%. So no surprise there, right?
Yeah.
But if housing goes back up, I think that could be a big part of or a very important part of the story of 2025, right? I mean, without, again, talking about the outlook and things like that. I didn't actually write about the housing data last week, because I've been thinking about this for a while. Like, there's so many things happening in the housing because rates are coming down, refinancing, mortgage activity, applications data, home equity lines of credit, HELOCs, things like that, right? It's like untapped capital, even as home equity increases for most homeowners, because home prices have gone up. So yesterday I wrote a daily note, Brian. I don't know if you've seen it. It was a crazy note. Now I'm thinking to myself, what was I thinking? Spent like an hour and a half writing, and there are like 20 charts in there. There's a daily email we send out to clients. There are about, not clients, our advisors, I should say, but yeah, 20 charts in there. Most of it is housing, but I've been thinking about housing a lot, and because I think monetary policy works for the most part through housing. It's the immediate impact on housing. So it's been good to see housing starts, permits start to slowly pick up. Hopefully that means we're on an uptrend, but we'll see over the next few months.
No, absolutely. Yeah, I did read that note. There was a lot in there. I needed some more time to dive in. You spent a lot of time into it there. I mean, let's talk about this. So that's housing. You kind of hinted at the consumer. The Fed's Z.1, what's that called? Fund to flow? What's it called? What's the official title?
It's the fund flows report.
Fund flows report.
Yeah, and then the New York Fed comes out with their household debt and credit report as well, showing you how much of debt is there, on the household balance sheets, things like that.
And those come out quarterly, and that data came out maybe a month ago or a few weeks ago. But I kind of want to talk.
I was on sabbatical.
Yeah, you're on sabbatical, but it's all right. We'll get into it, because we keep hearing about the record credit card debt and about all the debt that's out there, and you just kind of talk about the consumer. Maybe there's untapped, potential income and incomes and money that there from people's houses that they weren't able to use. What are some of the things when you get a chance to look at that? Because I know I've got some. Just the overall debt level in the United States is 17.8. Or 17.8 trillion. Yep. It was up only 0.6%. That's the slowest quarter-over-quarter change since the second quarter of 2003. But you pointed out disposable income was up 0.7% in the first quarter. So one could argue that disposable income is actually increasing faster than debt, which is not what they tell you on TV. You want to talk about that?
No, exactly. You have to normalize it, right? Because credit card debt, like it's $1 trillion, 1.3, but the economy is 28 trillion now, right? Disposable income is a good fraction of that, right? So you have to normalize it. How do you normalize it? Normalize it with disposable income. Credit card debt as a percent of disposable income is about 5.5% now, right? That's slightly below where it was before the pandemic. And remember, before the pandemic was actually kind of abnormal because people are still deleveraging. We had the housing crash. Stocks crashed. Stocks came back by 2013. But the real estate market was like in a funk for so long. Home prices, a lot of people who bought in 2006, 7, 8 saw home equity values crash, right? So people are deleveraging, trying to improve their balance sheets. So almost comparing right now to the pandemic, pre-pandemic time is sort of like, you're comparing to an abnormal period where, people are so delevered because they were trying to improve balance sheets. And right now we are in a good place with balance sheets and people are still delevered, right? What's interesting is this may sound strange to, the way I say it, but I'm surprised people aren't taking on more debt. Debt isn't increasing faster.
Oh boy.
Right? But I know I'll get a lot of blowback for that and credit card debt and all that. But then, the other side is look at delinquencies, And people are like, oh, delinquencies are going up. For one thing, because people aren't taking on a lot of debt, right? Delinquencies are rising, especially on credit cards. But then that's a portion of a smaller percentage of the pie because, people don't have a lot of debt balances right now, right? You look at delinquent balances, overall delinquent balances that are severely delinquent, like 120 days late, plus severely derogatory as they classified. That's just 1.7% of total balances. This is across mortgage debt,
Yep.
auto loans, credit cards, all of it, right? Before the pandemic, it was 2.8%. In the 2000s, 2006, 2007, it was about 3%. So we are well below that right now. Even if you just take credit card debt, right? Credit card delinquencies. So this are, and let's say 90 plus days or more. As a percent of disposable income, it's 0.6%. Now that's higher than the 0.5% before the pandemic. But remember, I said before the pandemic was kind of an abnormal time. You compare it to the 2000s, 2003, 4, 5, 6, it was about 0.75%. We're at 0.6 now, right? Credit card delinquencies as a percent of disposable income. So just to put it in perspective, I think you like to say it, denominator blindness. I think that, fits the bill nicely here.
Well, no, well said there. So in a lot of ways, yes, there's record debt. There absolutely is, but there is a lot of equity. There's a lot of net wealth out there, and that's that denominator blindness. You mentioned credit card debt as a percent of disposable income, 5.5%, and it was that's a tad lower than pre-pandemic. It was actually up over 8% before the GFC. Think about too much leverage in the system. Well, we know the GFC was obviously a big issue because there was a lot of leverage in the system and a lot of debt, and that went the wrong way when that domino started to fall. One other thing, I thought I had something else here. You shared this, and you maybe said it. I'll say it a different way. If you look at just how many payments are on time, it's 96.8% of all payments on time. It was 96.9% at the end of last year. So not like things are spiraled out of control. Maybe a tad worse, but not really out of control. And then, like you just pointed out there, the 1.3% severely delinquent versus 1.7. Or two, let's see here. What do I have?
1.7, I think.
End of 19. So anyway, there's a lot of ways to slice and dice that, and we're not naive to the fact there is a lot of debt out there. But honestly, when you really look at the data, credit card delinquencies are maybe one area that's showing some cracks. But to be honest, there's just still a consumer that's fairly strong still. In a way, we're kind of normalizing in a lot of ways back to where we were pre-pandemic. We watch this data, comes out quarterly, I guess. We're watching it every single quarter. I don't have anything else.
One final stat, just combining it all, like we were talking about credit cards, but take overall debt balances. That's seriously delinquent. Severely delinquent, I think, is 120 days plus. Seriously delinquent is 90 plus days behind. So you take that as a percent of disposable income, that's running at 1.6%. Before the pandemic, we were close to almost 3%.
Wow.
Right? Even in the 2000s, it was above 2%. We are well below that right now. So, like I said, household balance sheets are in decent shape. In fact, like I said, I hate to say it this way, but I am surprised that, debt hasn't increased more than it already has.
One final one, consumer bankruptcies. It has increased a little bit quarter over quarter, but it's 136,000, what we had last quarter. But to put that in context, it was over 200,000 consumer bankruptcies the fourth quarter of 2019. So again, before COVID. So we're about 31% lower in the number of bankruptcies right now than before the pandemic. So again, next couple of quarters, maybe that keeps trending higher. We're going to watch it closely, but I think it's really important to put that context out there. My other dog, Walter, he's 100. I don't know, maybe 150 pounds. I think he's put a few LBs on. A Great Pyrenees. He runs in his sleep. He's over there snoring away, so nobody's running. And the dog, the vet literally told us he needed to work out more, eat healthier. So he's just snoring, like running in his sleep. You guys don't have a dog, right?
No, we don't have a dog. Okay. So there's some allergies. I'm more allergic to cats, I think, but then dogs are. The thought of having to take the dog out for a walk when it's minus 25 degrees outside is still like a big hurdle for me, I think.
Well, in Chicago, that would be. Here, we've got the invisible fence. I don't believe it's publicly traded, but a few big fans of it. You put a little collar on them, maybe a little beep. What's that?
It's working.
It works. You just open the door and they go outside and they don't go anywhere. So yeah, it's pretty darn nice. All right, so let's finish things up. How are we doing time wise? We've got 10 minutes, right?
Yep.
Let's finish things up with the idea of a sugar high, because listen, stocks are up 9 out of 10 months. The time we're recording this, we're higher in September, so that'd be higher 10 out of 11. I mean, eventually we're going to have a down month here. I hate. I mean, we've been bullish. We're not complaining, but let's be honest, Sonu. You know that's going to happen eventually here, and who knows? Maybe it could happen sooner than later with October before the election right around the corner. We'll talk more about elections in October here coming up soon. But you did a really cool piece just talking about sugar highs and stocks going up, but there's actually earnings going up and profit margins going up. You want to kind of talk about what you found?
Yeah, I actually got the idea. I saw you on CNBC, and
what did I say?
you're like, things are
Who
good.
knows? I don't know.
Literally what we just talked about, right? I mean, it was the whole idea about the Fed cutting and it not being a panic cut, right?
Yeah.
Going big doesn't imply like bad things are going to happen or there's a monster under the bed or anything like that. But I think the anchor brought up the fact that, wait, Ryan, is this a sugar high? Obviously, he said no. But I was thinking like, okay, sugar high. Okay, if it's a sugar high, then that means, maybe more of the return, more of these record highs are coming because of valuations, right? And you can break returns down. We've done this. We've talked about this before. I've written blogs as well about this. You can break returns into three pieces, right? Dividends, right? Dividends are not a big part of it, but for the S&P 500, it runs like 1%, 1.2%, something like that every year right now. But then you also have profit growth. How much of returns come from profit growth and how much comes from valuations, right? Let's say like price earnings multiples, right? That's almost like a beauty contest. How much are people willing to pay for future earnings, right? So that's always subjective. It depends on sentiment, things like that. So you look at the year-to-date return for the S&P 500, but it's up about just under 21%, right? Before, actually, let's rewind. Back on July 16th, it was when it hit a record high. It was up about 19, 20%. Most of the return, about 10%, was coming from valuation growth. 9 percentage points came from earnings growth, profit growth, right? Okay. Now it's flipped because over the last month, I know we talk about the Fed and things like that, and what they did is important. I don't mean to minimize that. I think it's a big deal, as I mentioned. But profits expectations have been going up over the next 12 months. Profit expectation for the S&P 500, it's gone up to $267 a share, right? It was $264, I think, at the end of earnings season. So we've seen that continuous climb up in earnings expectations. Right now, the S&P 500 is up about 21% year to date, about 1.2 percentage points coming from dividends, 9 percentage points from valuation, and about 11 percentage points from profit growth, right? So it's now profit growth that's driven most of that, year-to-date gain, that record gain for equity markets.
Let me just jump in for a second. So you said 267. Is that what the 12-month is right now?
Yeah.
And it was around 225 at the start of 2023. I remember we were promised a recession by so many people. People wonder, why are stocks up so much? It's just because the Fed is printing money. The Fed moves things. But when you tell me earnings have increased like that the last less than 2 years, that is why the stock market's had looking at back-to-back 20% gains, and that is why we're flirting with all-time highs as we speak here. Sonu, I'll just chime in this. When we didn't do the podcast last few weeks because we were again pre-recorded a few of them, we saw the worst week of the year a couple weeks ago and followed up with the best week of the year. So I looked at when you're down 4% one week and then up 4% the next, Sonu. And let me see if I can find it. I swear I had it in front of me. There it is. 1 year later, stocks higher 18 out of 22 times. That's about 82% of the time higher. So that's better than average. And the median return a year later is almost 19%. So again, You're talking pretty solid returns. It's like a flush out, a puke, whatever you call it, and then a buying thrust. Also, 2 weeks ago, we had what I call a perfect week, meaning all 5 days of the week were higher. Not surprisingly, you tend to see these in bull markets. I don't think that's a surprise. And when you have a perfect week that takes place above a 200-day moving average, because we've had some that flow. So I was one that's kind of like now, where we're up, and within 3% all-time high. So again, you're a perfect week, but in a bullish trend like we just saw 2 weeks ago. A year, let's see, the average return a year later is about 14%. Median return is about 17%. And higher, I can't even remember my own writing, 25 out of 28 times, up about 86% of the time a year later. So just threw a lot of numbers out there, but the reality, a lot of these numbers we've been citing on this very Facts versus Feeling podcast for 2 years now have been suggesting this is a bull market. It's still a bull market. We're still there. And you just said it's not a sugar high, which is a good thing because it's justified by earnings. You want to talk about profit margins for a minute?
Yeah, I think if you can break earnings down into two pieces, sales growth, and that's strong because nominal GDP is strong, right? We just talked about the economy not being in a recession. In fact, nominal GDP is growing anywhere between 4.5% and 5%. That's stronger than pretty much the average over the last decade was 4%. You're running higher than that. In that event, you would expect sales to be strong, revenues to be strong. But companies in America, this is where, corporate balance sheets are important. What the corporate sector is really strong in America. And as they have something called operating leverage, which means as sales increase, margins go up. And that's what's happening, right? So if you break down earnings growth into sales and profit margins, like I said, 10 percentage points or close to 11 percentage points of the year-to-date return has come from profit growth, right? For the S&P 500, more than half of that is coming from profit margin expansion, right? Just slightly under half of it is coming from sales growth. So I think that's a key part of the story of, basically corporate America doing really well. And even if pull the horizon back, right? Go back to the end of 2019, people and this gets to like what you just said, right? The market has strong momentum. So the tape is strong. You have a dovish Fed and the economy is in reasonably good shape. And now the Fed's cut off that recession tail risk as well. Maybe post-election, they could be buying as hedges come off, things like that, seasonally strong period. So, a lot of things point to tailwinds for the market. And go back to the end of 2019, over the last 4 years and 9 months, we're close to the end of the quarter here. S&P 500 is up 90%. 90%. Out of that, 57 percentage points has come from earnings growth, profit growth. 14% from dividends. So don't discount dividends here, right? That's 71% out of 90% total return coming from fundamentals. Only 19 percentage points has come from valuation expansion here. So like as it goes back to the point of this is not a sugar high. This is coming on the back of profits. And rounding out to the top, what we talked about with the Fed, the Fed's backstopping the economy too.
No, well said there. Just some more markets things as we kind of wind down. Consumer staples relative to the S&P 500. So that's a relative basis. Hit a new low again. Okay. So staples are, maybe they're going up because everything is going up, but they're not going up as much on a relative basis. That's what you tend to see in a strong bull market. You don't want it because the utilities have been leading. We've talked about them before. But if staples were also leading, I think I'd be much more worried. Well, I'm not. The New York Stock Exchange advanced decline line just hit a new all-time high like earlier this week. That, again, suggests a lot of breadth, a lot of participation. We've talked extensively about that a long time.
Not just 7 stocks, right, anymore.
Not just 7 stocks or 4 stocks or 3 stocks. It's hundreds, almost thousands of stocks actually are partaking in this bull market. The number of net new highs, so that's new highs minus new lows on a New York Stock Exchange, just hit another new high during this bull market that's been going on for a couple of years now, again suggesting most stocks are going up. That's definitely a positive. We've hit 40 at the time of recording this, 40 all-time highs this year. That extrapolates out to mid-50s or so. It's probably not going to be an all-time record, but that's a lot of new highs, and this could be potentially one of the most new highs we've ever seen in any one particular year. Last thing, Sonu, we've talked a lot. September is usually not that great. Yes, it's later in September when you hit some trouble, so we're not quite out of there yet. But we hit a new high in September, which isn't all that normal, honestly. I took a look. When you hit a new high in September, what does it mean maybe for the fourth quarter? Maybe there's some signal here. Fourth quarter has been higher 19 out of 21 times. It's 90% of the time. When you hit a new high in September, like we just did, up about 5% on average. Your average fourth quarter is up like 80% of the time, about 4%. So a little bit better. We're just looking for these little clues, little nuggets that say, hey, maybe the fourth quarter can be a little bit better. I broke it down by an election year. Very small sample size, but we're still going to look at it. 6 times we've hit a new high in September of an election year. things get even better. 6 times the fourth quarter is higher, up about 6% on average there. So, I don't know, a lot going on there, Sonu. I know you've got a meeting coming up. All in all, it's a bull market. We're still optimistic. It is October coming up, so maybe we get some of that pre-election jitters. Wouldn't be a shock if it happened. We'll talk about it. What are you watching this week here as we kind of wind things down?
I find myself watching markets a lot more. I mean, I'll summarize everything and you just said underlined by saying, trust the tape. Mm-hmm. And coming back, I told you I was thinking about, the housing market. Yeah. Home builders, another example, right? And home builders have been close to hitting new highs again. They've recovered, right? We saw them do that in the early part of this year. Then there was, as mortgage rates hit 7-8%, they were in a funk, and now they're coming back. And I think you have to draw signals, and like I said, trust the tape.
Mortgage companies, there's not that many, and I'm not going to give it away because I can't talk individual equities, but mortgage companies, like some of them are hitting all-time highs, okay? Like nobody's refinancing right now. No one. So it's almost like the market is making a pretty significant bet, if you will, that there's going to be a wave of refinancings and housing and da-da-da-da because mortgage companies are hitting all-time highs. One other thing, I think it's so important to point this out. Tom Lee, when we did episode 100 with Tom live in Florida a few weeks ago, and you can listen to that replay, it was amazing. Tom pointed out then, and remember, this was like the second week of 10 days into September when everybody's bearish and worried about what's going on. Tom said, hey, look at high yield. All right, high yield corporate bonds are breaking out to multi-year highs. All right, so maybe stocks were wishy-washy weak the first 10 or so days, calendar days of September. High yield wasn't, all right? And I thought it was a great call by Tom. And now here we are 2 weeks later, and we've got these new highs across the board. So, again, kind of follow the credit markets, follow high yield, and there are some clues out there. Well, Sonu, I wanted to read, let's see, I've got it here. If you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave us a review. We love your feedback. All right, well, everyone, thank you so much for joining us. Next week, Sonu, you want to talk about next week real fast? It's the Super Pod. You want to talk about that for a second? Yes,
we have the podcast we did with Brian Portnoy and, the CEO of, Asset Map as well. So definitely check us out for that one. I think we get into like behavioral finance and sentiment and things like that. So that was a good one.
It was a lot of fun. I mean, it's a bigger picture look at kind of, I don't know, I'm looking for, let's see here. Give me 1 second here. I forget his name also. Sorry to the CEO of Asset Map. I was looking here. There's his face. Sorry. But nonetheless, it was a really good conversation, kind of the psychology behind markets and helping financial advisors and helping clients and we enjoyed it. So that'll be that'll be episode 102 or 103. That'll be episode 103 of Facts versus Feelings next week. You'll enjoy that, and then we'll be back doing some more regularly scheduled podcasts. So again, this was episode 102 of Facts versus Feelings. The Fed goes big. Take care, everyone. Have a great week. Enjoy the end of the start of fall, but the end of September. And if you're a Bengals fan, it was like the end of your year. You start 0-3, only 6 teams ever made the playoffs. It's not good. It's like the season's over before it starts. But we'll see. All right, see everybody later. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.